Hey everyone, welcome back to Economic Hero, where we break down the latest financial trends and market insights. Today, we have a deep dive into the recent performance of the S&P 500 and why you need to be cautious about the market's current state. Let's start with a fascinating fact. Currently, just 5 stocks make up a third of the S&P 500. That's right, just 5. For example, check out this headline. Almost half of the S&P's top sector performance this year has come from one stock, NVIDIA. Analysts are buzzing about NVIDIA's dominance and its impact on the S&P 500. While it's not unusual for one sector to lead the market, it's quite rare for a single stock to wield this much influence. But now, take a look at recent headlines. They're filled with warnings that these high-flying stocks have peaked and might be headed for a downturn. Analysts predict earnings are set to stagnate and normalize, urging tech companies to boost their guidance to sustain the rally. Here's the kicker. In 2023 and 2024, all the earnings growth in the S&P 500 came from just 7 mega-cap stocks. Without them, the index would have shown negative growth. Over the next decade, giants like Microsoft, Apple, and Alphabet face the challenge of growing their revenues fast enough to maintain high earnings growth rates. This situation mirrors what happened during the dot-com crash in the late 1990s. Sales revisions were the key indicator back then, signaling when a momentum reversal was likely to stick. The potential resurgence of the AI trade could lead to a comeback for large-cap stocks. However, a lot depends on revenue revisions. If big tech companies beat and raise their sales guidance, the S&P 500 could outperform again. But there's a warning sign. Insiders have been selling shares at a rapid pace, which could be an early indicator of trouble ahead. Take Warren Buffett, for instance. The Oracle of Omaha has been offloading stocks worth billions, citing the historic overvaluation of the S&P 500. Jeremy Grantham, a highly influential economist, is also calling the end of this rally. He points to full employment and a high Shiller price-to-earnings ratio as signals that stocks will likely underperform in the coming years. Let's delve into Michael Burry's perspective. Known for his accurate prediction of the 2008 financial crisis, Burry has been vocal about the current market risks. He's particularly concerned about the rise of passive investing, where money flows into index funds without regard for individual stock performance. This trend has led to the top 10 mega-cap stocks in the S&P 500, comprising more than a third of the index. This situation creates a feedback loop. As investors pour money into ETFs, the funds must buy shares of the underlying companies, which boosts the prices of the largest stocks disproportionately. This makes the market seem more stable than it actually is. Over the last few years, the market cap-weighted S&P 500 has outperformed the equal-weighted index due to this very phenomenon. Burry draws a parallel to the pre-2008 bubble in collateralized debt obligations, CDOs. Just as CDOs distorted housing prices, massive capital flows into index funds are distorting stock prices by removing price discovery from the markets. Let's imagine Tesla was 5% of the S&P 500 before NVIDIA's rise. As NVIDIA's share price surged, its market cap increased, forcing fund managers to buy more NVIDIA shares and sell Tesla shares. In the future, new companies will replace today's leaders as they rise in prominence, causing a shift in market dynamics. NVIDIA, now a top 10 stock, will eventually face the same fate as others that have fallen from the top. Burry believes we're on the brink of a major market correction, one that could see the S&P 500 dropping significantly, possibly by as much as 53%. A major reason for this impending crash is the expected reduction in corporate share buybacks. Since 2000, corporations have accounted for 100% of net equity buying. Companies like Apple, Microsoft, Alphabet, and NVIDIA have dominated buybacks, with Apple alone projected to account for over 10% of 2024's buybacks. Pensions and mutual funds have been net sellers, while corporations have been the top buyers, driving up market performance. However, changes to the tax code, a reversal of profitability, or an economic recession could reduce share repurchases. The era of cheap money is ending, and with rising interest rates, corporate profit margins are under pressure. Additionally, geopolitical tensions, a shift towards de-globalization, and rising corporate debt levels are adding to the economic challenges. Many companies have borrowed heavily to fund buybacks and dividend payments, and as interest rates rise, the cost of servicing this debt will increase. This could lead to reduced profit margins and even a wave of corporate bankruptcies, further depressing stock prices. The global economy is also facing significant headwinds. Trade tensions between the US and China, ongoing conflicts, and political instability are contributing to an uncertain economic environment. These factors are likely to weigh on corporate earnings and could trigger a broader economic slowdown. Investors should also be wary of the increasing influence of algorithmic trading. High-frequency trading algorithms can amplify market volatility, leading to sharp swings in stock prices. This can create a challenging environment for individual investors and contribute to overall market instability. As we wrap up, it's clear that Michael Burry's predictions about the S&P 500 aren't just warnings. They're detailed analyses of current market dynamics. The heavy reliance on a few mega-cap stocks, the rise of passive investing, and the reduction in corporate buybacks all point to a potential market correction. So, what should you do? Stay informed and make prudent decisions. Diversify your portfolio, reduce exposure to overvalued stocks, and maintain a long-term investment horizon. While downturns can be tough, they also present opportunities to buy quality assets at discounted prices. Burry's insights remind us of the importance of vigilance and critical thinking in investing. Thanks for watching Economic Hero. If you found this analysis helpful, make sure to hit the like button and subscribe to our channel for more in-depth financial insights. Stay tuned, stay informed, and see you next time.